What's up, everyone? Welcome back to another video. This week I have started a new portfolio that I'm calling the Dividend Growth Income Portfolio, and I'm going to share the growth of development of this new account here on the channel. I'm often asked, how would I start as a beginner in 2022? And this is what I would do. Now, keep in mind this is a portfolio that works for me. We all have our own financial situations and objectives, so please don't take this as financial advice. I'm not a financial guru. I'm just a regular guy who loves dividend growth stocks. I think the best way to get started is with ETFs and index funds for that instant diversification. And these are a solid choice for the new investor if you aren't yet comfortable picking your own stocks. For today's video, I'm going to go over the ETFs I've chosen for this new portfolio. So I've opened up a new account with Fidelity for this portfolio, and I funded it with its first $100. I'm using them for another account I have, and they're a very solid brokerage, and I've been happy with them so far. I'm going to dollar cost average into a set of ETFs and high-quality dividend growth stocks with small amounts of money on a consistent basis. My plan is to add funds into this account every week. On Wednesdays, I'm going to make the purchases in this account whether the markets are up, whether the markets are down, or whether they're sideways. I want to show that anybody can get started with dividend growth investing thanks to things like fractional shares and ETFs, and you can build a diversified portfolio using small amounts of money. You don't need a lot of money to do dividend investing, guys. You need to be consistent for this to work. My ultimate goal for this particular portfolio is to generate $1,000 a month in passive income, which comes out to $12,000 annually in dividends. This is a long-term investing strategy. It will take a substantial amount of time and investments to reach this point. I'm thinking 5 to 7 years maybe. Dividend growth investing is not a get-rich-quick scheme. It's a slow roll and the snowball takes time. But dividend growth investing does provide a way for anyone to build wealth, and it's centered around a sustainable, growing source of passive income. Time and consistency is your friend, and compound interest takes care of the rest. Think of how awesome that would be to have an extra $1,000 coming in every month for doing nothing except holding quality businesses. Anyone can benefit from this, but it takes patience and a plan to get there. And my plan is to have two components to this dividend growth income portfolio. A few ETFs to set a foundation and a selected group of strong dividend growth stocks that we will begin slowly buying into each and every week. ETFs are to make up about 25% of the portfolio, and the other 75% will be in high quality dividend growth stocks. This is a balance I feel pretty good about. We will just be focused on the ETFs for today. Next week, I'll reveal the dividend stocks that I've selected to be focusing on for this account. So if you aren't familiar with ETFs or exchange-traded funds, they operate similar to mutual funds. They hold a collection of equities and often track an index. Instead of buying an individual stock, an ETF represents a basket of stocks, allowing one to get instant diversification via a single ticker. I believe ETFs are an amazing tool for the investor, and there are many investors who only invest in ETFs and index funds, and this is a perfectly fine way to invest, I think. Now to start, and for the first year at least, I'm going to be focused on 3 ETFs. One broad market index, which is where 25% of the ETF funds will go, and then 2 dividend-focused ETFs, weighted at 40% each. I see these 3 ETFs as the foundation, the backbone of this portfolio. The first ETF I've selected is VOO. This is the Vanguard S&P 500 Index ETF. With this, you get exposure to the 500 largest publicly traded companies in the United States. This is probably the #1 benchmark used to gauge a portfolio's performance. When we say, how did the market do today? We're usually talking about the S&P 500. This really should be a core holding in just about any portfolio. Rather than trying to beat the market, when you have an ETF like VOO, you are the market. Historically, this has resulted in an annual rate of return of around 10%. The holdings in VOO are weighted by market cap, and what I love is that with the click of a couple buttons, we can buy into this fund, and we have ownership in 500 companies, and so you're very diversified. This is especially important when you're starting a new portfolio, which is what we're doing here. When looking at how VOO breaks down by sector, tech makes up close to 25% of the index, as most of the largest companies are tech companies. Healthcare is second largest at just above 14%, and third is financials, just below 13%. And pictured here on the screen is that entire breakdown with all of the sectors. Here are the top 10 holdings, which make up 28% of the S&P 500, and you probably know all of these names. Apple at 7.2%. Apple is the largest company in the world, and they make up a massive part of the index, a very significant chunk. Microsoft is also very large. They're second, coming in at just under 6%. Amazon, third at 3.3%. Tesla is ranked 4, making up just a bit over 2% of the S&P. Then Alphabet, or Google, has 2 shares of classes, which combined make up a little less than 4% of the index. Following that, Berkshire Hathaway is above 1.5%, and United Health Group Inc. is just below 1.5% of the S&P. And the last two are Johnson & Johnson and ExxonMobil, both at about 1.2% of the index each. The other 490 companies in the index make up the other 72% of VOO, so we are heavily concentrated in those above companies. One nice part about holding VOO is, as the markets move, these weights all change as companies rise and fall on the index. Holding VOO, we don't have to worry about any of that. Everything is rebalanced for us. The top 10 companies by market cap were different 10 years ago, and they'll be different 10 years in the future. We don't have to worry about selecting the right ones. In fact, just a couple months ago, both Meta and Nvidia were top 10 holdings on the S&P, but both have taken significant falls recently. So by holding VOO, you will simply continue to track that S&P 500 index as it evolves. And I love this investment strategy. And you get all of this for next to nothing with an expense ratio of 0.03%. This means you're literally paying $3 for every $10,000 invested. Since this is a dividend account, let's take a look at what we can expect with VOO. Here we are essentially getting the dividend yield of the broader market, which is right now at 1.59%. If we look at the dividend yield history here in Seeking Alpha, that dividend yield is considerably lower than its average. Historically, the average yield is around 1.8 to 1.9%. So this is an indication that the broader market as a whole is overvalued, as it's not uncommon for the dividend yield of the S&P to be above 2%. Also note the 5-year average dividend growth rate of 6%, and I use this as a sort of benchmark for stocks in the portfolio. I really aim to see the stocks I select grow their dividends at a faster rate than what the market is doing. The VOO pays a quarterly dividend, and the amount varies, as with all ETFs. The forward annual dividend VOO is paying as of the publishing of this video is $5.65. The last quarterly payment was on July 5th, 2022 for $1.43 per share. VOO pays quarterly dividend in the months of March, July, October, and December. Now, I'm sure some folks are wondering, why not go with the total stock market index such as VTI? I gave that some thought, and in my opinion, you really can't go wrong either way. I wouldn't see much point in holding both in a portfolio like this, as you'd have a lot of overlap between the two. The S&P 500 makes up about 86% of the total stock market index. And in the other 14%, you're getting the small and mid-cap companies. Either way, I think you're doing pretty well buying into either one. And I just happen to have a preference for the S&P 500. And also note, we could have just as easily gone with SPY or IVV or SPLG. These are great options for an S&P 500 index ETF, but I went with the Vanguard VOO for this account. And as I'm going with VOO, I'm going to allocate about 20% of all my ETF purchases into VOO. Here I am making my first purchase of VOO on the Fidelity website, and I recorded this on the morning of September 14th, 2022. And this purchase gave me 0.055 shares of VOO for $19.98 at a cost basis of $363.21. This added an estimated 31 cents to my portfolio's forward annual dividend income, and that is the first bit of income I bought for this portfolio. For my second ETF, I've decided to add Charles Schwab's SCHD, the Schwab US Dividend Equity ETF. SCHD tracks the Dow Jones US Dividend 100 Index, and it contains 104 stocks. Probably not a surprise this was my first dividend ETF. This one is a darling of dividend growth investors, and it's very easy to see why. In their own words, the index is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends selected for fundamental strength relative to their peers based on financial ratios. The companies in SCHD are highest concentrated in the financials, industrials, and technology sectors, followed by consumer staples and healthcare. The top 10 holdings in SCHD make up almost 41% of the index, so this one is heavily concentrated on its top 10 holdings, so we should take a look at those companies. The highest weighted stock in the ETF is PepsiCo Inc., ticker PEP, making up 4.4% of the index. Next is Texas Instruments, ticker TXN, making up 4.27% of the index. Third on the list is Cisco Systems Inc., ticker CSCO, and they make up 4.25% of the index. The next 7 stocks in the top 10 are Amgen, Home Depot, Merck & Company, IBM, Broadcom, and Pfizer. 90 other companies make up the remaining 59% of this ETF, and I'll scroll through these slowly. You can always pause the video here if you like. There is a lot to like about SCHD. Let's start with the fact that its 1, 5, and 10-year historical performance have outperformed the S&P 500 in terms of total return. Market-beating returns and a dividend yield more than twice the S&P 500. The current yield for SCHD is a tasty 3.41%, which is 23% higher than its 5-year average. So while the market's yield is well below its average, the folks at Schwab have been managing this ETF that is outperforming the market, has a dividend yield that is well above its historical average, and has been growing its dividend at an amazing rate of 13% annually. And the management fees for this are again extremely low. 0.06% comes out to $6 for every $10,000 invested. Everything about this ETF is a screaming buy to me. The annual forward payout is $2.43 per share, and SCHD pays quarterly in the months of March, June, September, and December. So SCHD is going to make up 40% of the contributions I make towards this portfolio's ETF component. Here is the first purchase of SCHD in the portfolio, putting $40 of my first 100 into SCHD. So this starts us off with 0.556 shares, just over half a share of SCHD for $39.97 at a cost basis of $71.89 per share. This adds an estimated $1.35 to the portfolio's forward annual dividend income, bringing our total forward income thus far to $1.66. So that's 20% in VOO, 40% in SCHD, and 40% in the final ETF. And for this one, I had my list narrowed down to 3 ETFs. The third ETF I've chosen is VYM, the Vanguard High Dividend Yield ETF. I was between this and VIG, the Vanguard Dividend Appreciation ETF, as well as DGROW, the iShares Core Dividend Growth ETF. I'm not going to go into the strategies of each ETF in this video, but ultimately I decided I like the balance that VYM adds to the mix in this portfolio, and that is where I'm putting the remaining 40% of my allocations towards the ETF component of this portfolio. VYM tracks the FTSE High Dividend Yield Index and holds 446 different companies, so it's way more diversified than SCHD. VYM is diversified across all sectors except real estate, financials being the highest at 20%, followed by healthcare at 15%, and consumer staples at 13%. Industrials and energy both make up about 10% of VYM each, and utilities and technology make up about 8% each. The top 10 holdings look like this, and you can see it's quite different in composition than SCHD, with Johnson & Johnson being the top stock in this one at 3.1%, and then ExxonMobil is second at 2.95%. JP Morgan Chase, ticker JPM, is the third highest weighted stock in VYM at 2.43%. The remaining 7 in the top 10 are Procter & Gamble, Chevron, Home Depot, Pfizer, Eli Lilly, Coca-Cola, and PepsiCo. There are a lot of solid healthcare companies in this one. Now, those top 10 companies make up 23% of the weight in VYM. So we're not as dependent on these top 10 companies as we were in SCHD. The other 436 companies in the index make up the remaining 77% of the weight. And I'll have them scroll here on the screen slowly. Let's look at VYM's dividend history. It pays a nice yield of 3.1%, which is about double the broad market's dividend yield, and also a little bit above its own 5-year average. Its annual dividend growth rate is 6.7%. It does this with a very low expense ratio of 0.06%, or $6 for every $10,000 invested, which is the same as SCHD. It's very low. VYM pays quarterly. Its last payment was for 85 cents per share on June 24th, 2022, and has a forward annual payout of $3.20. The quarterly payments are made March, June, September, and December. Here I'm making my first purchase of VYM earlier in the week, adding the last $40 of my first 100 into VYM. This got me 0.383 shares of VYM for $39.96 at a cost basis of $104.33. This purchase added an estimated 1.23% to the portfolio's forward annual dividend income. So with the first $100, I can expect to make $2.89 in dividend income over the next year. Not very exciting yet, but it's the start. I'm using my active income here to create passive income. This is going to generate the first few cents of dividend income for the portfolio in the next couple weeks here, as ex-dividend dates for all three of these ETFs are coming up. And for the dividends I receive, they will drip or reinvest into themselves, and in time compounding will do its thing. And I think with ETFs, drip is a great strategy. So there you have it. This is a way one could invest $100 and be very diversified and set up for both dividend income and total growth. No worries about a single company going bankrupt in an index that holds 100 or 500 companies. These are the only 3 ETFs I'm going to be buying up in this portfolio for at least the first year or so. I'm going to build these up into nice positions along with a group of dividend growth stocks at a slow but steady rate. And after that, you could see me potentially adding a VIG or DGROW into the mix. So now the week is over. I'm down a little bit on that $100. We are yielding 2.93%, and I feel good about this. I'm aiming to keep this yield of this portfolio about 2.5 to 3%. I'm not chasing high yield, more focused on dividend growth and total return. So leave a comment down below on what you think of my chosen ETF strategy. That's it for today, ladies and gentlemen. I hope you found this useful, especially if you're a newer investor and lack the confidence in how to get started. It doesn't take much. Now hit that notification bell so you don't miss the second part where I will detail the set of dividend growth stocks where we will be slowly building up positions. One thing I'll say is that I currently own none of the stocks on this list that I'm buying up, so this is a way for me to increase my own diversification and exposure. As you can imagine, I am really excited to get this going. Please like, subscribe. It really helps out with the future growth of our channel here. I want to spread my love of dividends and investing and help clear things up for newer investors. Until next time, guys, keep investing.